Howdy, howdy. I'm switching it up a little bit of a different introduction, I guess. Thanks to Alex, kudos to you, Alex. So I guess I was using hello, hello quite a lot, and I kind of like it, so I probably will be using it in the future too. But I thought I would start with something a little bit different today. So welcome. I'm glad that you are here. And we're going to be talking about BP today, a very well known oil gas company. And this one has been going down as usual, I guess, with this current market. But it actually was lower. It was at 15 almost at some point. Now, obviously, after the war with Russia and Ukraine, oil tends to be hovering upwards, really. And so you would expect a company like BP to get some benefit out of that. Yet today they are down. I mean, it will still go up and down, but overall, it has actually gained a little bit, actually substantially, in the last few months or so, really. So let's start by taking a look at this one, and we're gonna be creating a discounted cash flow model to see what price actually we want to be paying for this company if we are to add it to our portfolio. And so here, the first thing that you will see is the outstanding shares, which are sitting at 20 billion. This is an insane amount. It doesn't really mean much, but we do see that this is a very heavy float for a company, and so it shouldn't really move that much in terms of price, even though it's 6% now. I'm suspecting the float is going to be similar to this, and you don't typically get these kinds of movements for companies that have so many shares, really, because there are too many shares to move the company towards one side or the other. The company is paying a 4.41% dividend yield based on the current price, that is, of course. And that's a very hefty one, and we're going to examine that because that's a fantastic dividend. And oil companies, gas companies tend to do that a lot just to attract some investors. Because the thing that you need to know and realize about oil is that it is a very cyclical market, and so it tends to be going up and down all the time. So you may be noticing a company making billions one year and then losing billions in the next year. So you have to be super careful about owning these companies because they can even go bankrupt, and a lot of those have. And they remain hidden between the lines. But if you actually take a look at what's going on in the markets, you will see that quite a lot of those have actually bankrupted, even well-known ones. And that's not only about fraud; it's also about debt. It's a very important thing about these kinds of companies. And you will see here that the PE is trending downwards, but we do want to examine the cash flow of the company because, again, being on a very circular market here, cyclical, we do want to see how time is treating the company really, and how much money they're making. And so let's start off by taking a look at the income statement of the company. And before we proceed, let me ask you to like the video if you do like what we are seeing here, and if you want to help me make more videos. And you may also want to subscribe. There's going to be a lot more, and I'm also preparing a tool that is going to be dedicated and is going to be exclusive to users and subscribers of this channel. So you may want to subscribe as well. And we'd love to see you on our Discord channel. You can find a link in the description box below this video. Now here, the total revenues of the company, as you can see, they are trending downwards for the most part, even in 2021. I'm assuming that this is gonna reverse a little bit. I would expect that, just because right now, again, the price of gas and oil is like super high, so I would expect that. But what about the net income of the company? Is from starting from 3.3 billion here to in 2017. And you notice 2020, a magnificent loss here. Wow. I mean, you would expect that because at some point, remember, the futures were negative for oil. And it used to be that nobody wanted to store oil at some point, remember? It's been like a couple of years since that. And then all of a sudden, now it's the exact opposite thing. As I mentioned, it's very circular, very cyclical. And right now it's positive again. And the next thing that I want to see, which is important for this kind of companies, I want to examine two things really. The total liabilities of the company, very important for a gas company. And this is sitting at $200 billion. What about the total assets of the company? Total equity, $90 billion. So that's an insane amount of debt here, as you can understand. So the company has a lot of debt and not enough equity to back that debt in case something goes wrong. So I don't like that. And what about the cash flow? The cash flow, first of all, actually, let me examine the cash from operations here. As you see, is positive over here. Again, 2020 was a bad year. But even though it's positive, even though the cash operations from operations is positive, you still need to examine and to remember always what the current market does and what the current trend is, because this can very, very quickly reverse, and all of a sudden you have 3 or 4 years where the oil prices are very low again. And this is why we want to be examining the assets that the company has, see if it's sustainable, if there is a downtrend for the market, for the oil market. So the cash from investing for the company is actually mostly invested in capital expenditures, as I'm seeing here. And the cash from financing is negative, and that's because of the long-term repay of debt. So you're actually repaying some debt back. So that's good to see. And also the dividend payments are pretty substantial here, 4 billion, which has to happen every year, of course. Some debt being issued, they issued more debt in 2020 because they were not doing that well, but they are still issuing 8 billion here in 2021. And what about the free cash flow from 2.3 billion, 6.1, 10.3? Look at that, minus 144 million. Now they lost in 2020. They actually lost money. But 2021 again back to positive to 12.725. What about the multiples of the company? They're very low. That's because the enterprise value compared to sales is low. That's also kind of typical for these kinds of companies. And the other thing that I want to examine is the profitability here. The return on equity is 10%. I guess, yeah, these are companies you wouldn't expect too much of a return on equity. It's mostly, I'd say this is mostly like income companies for you, for an investor, like get the dividend and maybe a little bit of growth over the years, but that should be it for the most part. And the total debt to equity quite a lot actually when you compare it to equity over here. And the liabilities even more, actually, the total liabilities, which may not actually be debt, but necessarily, and thus they are not recorded here as debt, but they are still liabilities that need to be paid, like in inventory, for example. So interesting about this company, and the dividend yield, interesting stuff here. Let's examine the dividend because I really want to see what's going on with the dividend of the company. The payout ratio is sitting at 57%, which is a little bit elevated, but not insanely elevated. So they should be able to afford making payments for that for a while, especially in the current situation where oil is actually creeping up and up. But you will see that throughout the years there have been some steep declines, and actually they even cut dividends here and they reinitiated it again and then they cut it here. That's another very, very typical thing for these kinds of companies, like oil companies, gas companies, and energy. Typically, companies, just because again they can be very, very cyclical in nature, and so you may have situations and seasons when the company actually cuts down on dividends completely, and then all of a sudden they reinstate it and they keep adding more to it, and then there's another cut, and then the same story. And so if it's very, very low, there may be an interesting situation where you can actually invest. But over here, you would expect that, for instance, it's like double the amount of dividend that they were paying. So their payout ratio back here was probably around 120%, or if not more. And so you would know that they were about to cut the dividends at that point. Now being at 56, 57%, they probably won't cut it for a while. So you may be able to reap some benefits if you invest now and maybe hold it for a few years. Maybe in the next 10 years you will have your dividend without any problems. So that's probably going to happen with BP, I'm assuming. The other thing, the last thing that I want to do is take a look at the free cash flow model here. I have already added the cash flows over here in this first line. And we're going to be using a discount rate of 13% for this one. I could go a little bit more because it's riskier, but I'm just going to stay with 13%. The free cash flow growth to use now is a little bit tricky because the company has again been all over the place, like they actually lost here, and it's very, very cyclical. So I'm gonna go with something very low, and it's something like 7%, and a perpetual growth rate of 1%. Now again, this may be a little bit more in some situations, but it really, really matters what the market is doing, and this is a 10-year discounted cash flow model. And so having something like 15 to 20% is more than likely never gonna happen for a company like BP here. and they have obviously billions in shares, and so the price per share to pay here, when all this is accounted for, is about $8.10. And right now the price of the stock is sitting at 28, so it's almost 3 times as much, as actually more than 3 times what we would like to pay. And so it's expensive for the amount of cash flow that the company is making, and the discounted cash flow model that I have created here. And even if you use a discounted free cash flow growth rate of 15%, which is, I think, very, very lucrative for such a company, you're still well below. I mean, you're just sitting at 13.82. And this is something that, you have to bear in mind. Now, again, this is a dividend company, it's an income-based company, and so if you really, really care about income, you may want to add a little bit, because this kind of dividend is lucrative, is almost 5%, and the payout ratio is fair, and so you may be able, again, to reap the rewards, the benefits for a few years. And so if you are really looking for that sweet cash, go for it. Although, you have to be wary that this kind of income, the dividend income, is taxed twice. It's taxed on the company level and on the individual level, and so it's very tax inefficient. That's why I'm not a huge fan of dividends. I like them when I get them, but they are not very efficient in terms of taxes. I prefer good growth companies, to tell you the truth, that are providing me with great cash flow. That's my cup of tea. Hopefully you found that video useful and gave you some ideas about BP. Let me know. And if you did enjoy that, please leave a like. That really helps, as I said earlier. And in the meantime, you may want to take a look at this video that I made earlier, and it discusses Alibaba and compares it to some other behemoths. See if it's cheaper or more expensive than those. Thank you for listening and watching this, and I'll see you soon. Bye bye.